Hi, I'm Jonathan Barratt. This 9-minute educational grab is all about trading foreign exchange options. You wonder why the banks still make markets in it? That's also because they also make good money in it. So in this 9 minutes, we're going to talk about just the basics of trading foreign exchange options. And if you need anything on that, then what I can do is suggest you download the demo and have a bit of a play there, because that's where you're certainly going to learn how a lot of these options actually work. I guess trading options. Obviously, you're trading against a market maker. The good thing about trading foreign exchange options is the market is so well defined to a lot of the large banks. So your spreads, your bid offers, and your volatility are all quite well defined, and that makes it easier because you've got a market, a bid and an offer that's there in the market 24 hours a day or during market hours. Not like some of your equity options where you've got to wait and really see what happens overnight in order to see whether or not you can get in or out. Now, people always ask me, well, how do you make money trading options? People say you only make money if you buy low delta ones. That's options that don't have a high probability that they'll become in the money. Other people tell me that they make money by selling options, grabbing that premium when it occurs. Well, it's not as simple as that in working out how to make money in options, because there are lots of very safe strategies you can employ that will help provide you with good return. A couple of the ones I like, basically buying short-dated, low-delta calls or puts, call option spreads, call spreads, which I like, put spreads. All these ones are all quite good and well-defined. But one thing I do like is using the option to your best ability, i.e., once you've chosen the direction correctly, look to trade the delta or the intrinsic value. I'll give you an example of that. If the Aussie dollar is trading at 90 cents and you bought a 91-cent call, once it gets above 91 to an agreed level plus your premium, then just sell this physical. You sell the physical, and you can buy and sell that physical as much as you need. And a lot of the interbank players actually use that type of strategy because it creates, it basically creates that ability to be able to book profit very quickly on that strategy. If you bought that 90-cent call, the market traded up to 91, or in fact up to 92, and you sold the delta or the physical, if the market then came back from there back to 90, your option premium would be worth 0, but you'd still have a short position. And I think that's the advantage. So I guess if I'm trading options, I like to be aware of what's really out there, how I can make the best out of the position that I have. Remember, if you're buying options, obviously the person that sells you the option puts in volatility to be able to enable him to get out of the position if he needs to. Likewise, you want the position to move in your favor in order for you to maximize profit. If you sell options, naturally you're the grantor, and you obviously want what the market maker wants. So you can really place yourself in each position to be able to benefit. But what we're going to do now is we're going to have a look on the Falcon at the option pricing board. The option pricing board, I think, is one of the best tools that we've actually got on the trader, and that actually helps us in terms of working out what options we'll buy. But first of all, we'll have a little bit of a strategy and have a look at that Aussie dollars and see if we can come up with a trade. Okay, as you can see here, this is the standard platform we've got with the Falcon, and if we look at the little Aussie dollar there, let's just grab that up here. There it is there. It's trading at 90.91, and as you can see there, we think it's probably poised to trade higher from here. And we would normally add to a position there on a breakthrough that high we had last night, which was about 91.26. Well, anyway, if it breaks through there, then our trend will be assured, so we're quite happy to run with that. Now, in looking at an option play here, there are two ones you can look at. You can either sell a call above the old high, say at 91.50, or you can buy a call with a strike similar to, say, 91.50. Now, obviously, you've got time on the call, and you want time to depreciate on the sold call. In this strategy, if we just turned around and bought a call option, how would we do it? We're using the trader. It's quite easy. We just go to our foreign exchange board, and as you can see here, we have all the strikes that we need. We have put options on this side, call options on this side. If we felt that the Aussie would trade higher, then we'd look at a call option, and we look at something similar to, say, a 92 call. And as you can see, these are the prices for a 92 call out to the 10th of May, 17th of March, 10th of March, 17th of March, or the 24th of March. And on $100,000, when you look at the 92 call for the 17th of March, which is pretty close, you can see that only costing 25 pips on $100,000, that's only 250 US dollars. So it's not that hard to get involved. The delta is 23 and the mid-vol is around about 11.18%. So in terms of a strategy over the next week that we feel the Aussie could get to 92, that's what it's costing us. So you can see that to get involved really doesn't cost a lot of money. Likewise, if you felt that the Aussie would fall via the same time period, 17th of March, then you can buy a put. Now look at the difference in the pricing. Obviously the put is a lot more expensive than the call. And the reason that is because it's in the money. Remember that strike price which we talked about, that 91, well, it's virtually in the money anyway. Last night it was, and that's a 91. If we look down to the 92, just to try and get it all in perspective, we can see that it's worth a lot more, 143 points, and that's actually the intrinsic value on that 92. That intrinsic value is the difference between the spot price and the strike price. And obviously it's in the money there. So as you can see, there are certainly various ways you can get involved in the options market. And you can actually look to strategize, like put a bull call spread on the Aussie, where you can buy the 91 and sell the 93. In this case, if you bought the 91 at 61, or bought the 91 at the 91 to the 24th of March at 76, and sold the 93, then the cost is the difference between that and that. So you can actually see by doing that sort of strategy, the call is not costing you a lot of money, but you are maximizing on the top side. Righty-ho. So it is quite simple to actually look at these sorts of things and these sorts of trading strategies, particularly in trading options. So what I think is that download a demo, www.falcontrader.com.au, look at the options model. Don't be afraid to use the demo. Buy and sell. I would look at either long-dated low delta or short-dated low delta. And I'd also, as an exercise, look to trade the physical once the option has come in the money and just job around your strike, because that's where some good profits can be made. Well, that's about it for the 9-minute educational grab. As mentioned, feel free to visit the website. Also, feel free to visit the YouTube channel where this will be on, along with other little tips that we have about trading some of the markets. But good luck, and feel free to give us a call or attend some of our educational webinars.